I'm Mark Gagan and welcome to a special episode of The Voice of Insurance, produced in association with Beazley. Our industry is a mature one, and because of that, growth stories are highly valuable. Well, today we're looking deeply into the best growth opportunity for insurance in decades. And to that end, we're going to examine an industry experiencing exponential growth and looking to multiply the amount of capital that it deploys tenfold over the next 5 years. We're of course talking about data centers. The huge demand for computer processing power unleashed by the boom in the application of artificial intelligence is a key driver of this new demand. On a recent results call, Aon CEO Greg Case said that this new phenomenon could generate over $10 billion in new premium volume in 2026 alone. Yes, 10 billion. I imagine I have your full attention now. But whilst the opportunity is enormous, so are the challenges. We won't get $10 billion in new premiums a year without taking on substantial new volumes of risk. The sheer scale of investment in new data infrastructure is staggering, putting immense pressure on traditional construction methods, supply chains, power grids, the environment, and of course the traditional insurance market that is being asked to provide insurance cover for this unprecedented surge in the construction of vast assets. To help us analyse this opportunity from all angles, we've convened 4 experts, each offering a unique perspective, from an investor owning and operating the centres to the underwriters covering property, environmental and renewable energy risks. So I'm delighted to be joined by Atul Roy, an investor in digital infrastructure at Cordiant Capital, who's representing the customer in our discussions. Lindsay Shipper, head of North American commercial property at Beazley, Ben Shepherd, a renewable energy underwriting expert, and Nicholas Pearson, who's a specialist in environmental liability risk and underwriting. The headline figures for this market are immense. When we look at the capital flowing into data centres, we're talking about numbers that challenge our current notions of accumulation risk. But let's start off by getting a sense of the scale of the opportunity here. The consensus among analysts is that capital deployment in this sector has fundamentally reset. Atul Roy told me just how rapidly these numbers are set to escalate.
Based on Bloomberg, McKinsey, any of the reports you pick, for next 5 years alone, you would see between 5 to 6.5 trillion spent. These numbers were not like this before. So it's a very large jump here.
That scale-up represents a 10 times multiple of total investment in the next 5 years compared to recent activity. This growth translates directly into a massive increase in the average physical size of the facilities at risk. What used to be considered a large facility is now just average. Back to Atul.
The data center used to be 2, 3, 4 megawatts, 5 megawatts. 10 megawatt will be considered a very large data center. Now a 10 megawatt is more of a normal, a smaller data center. And these are, in terms of translating these megawatts, a 10 megawatt data center can power a small city.
This rush to build is creating immediate challenges for insurers, particularly for those in property and construction. Some individual risks are reaching anywhere from $5 billion all the way up to $25 billion in total insured values. I asked Lindsay Shipper whether what's new for the industry was the size of the risks or whether it was the complexity. This is what she had to say.
I think it's both, because the size is also requiring different energy consumption, different energy requirements than what you saw before, which is bringing a whole new exposure, a whole new risk that, quite frankly, a lot of insurers in our silos aren't necessarily prepared for. We don't understand it. So the education needed in the industry right now to keep up with the pace of the data centers is huge.
And what's the sort of order of magnitude when we talk about a traditional data center? What sort of limits? There's no such thing as a standard risk, but if something is fairly the sort of median risk, what would be your absolute run-of-the-mill, here's a totally typical risk? What sort of limits you'd be looking for? And then, therefore, what sort of multiples are we looking at that now with these new ones?
Right. So historically, a traditional data center, you're talking $500 million to $1 billion in total insured value, or TIV, and therefore the same limits typically applying. Now you're talking about these hyperscalers at $5 billion to $25 billion. And then when you start getting investors and lenders involved who are wanting to protect those investments and the insurance requirements that they're placing on the developers or the owner operators, you're seeing limit requirements to the magnitude of $5 billion to $10 billion. So it's really testing the available capacity in the market.
Wow, so we're talking limits of up to $10 billion per site here. No wonder Lindsay is using the word hyperscaler. These limits are 20 times what was normal only a few years ago. But it does look like the insurance market is coming together to marshal the limits required. first on the construction side, and then, once the assets are operational, moving that capacity over to the property side of the equation. Here's Lindsay again.
You look at most property insurance carriers, whether on the operational or the builder's risk side, have 100 million to 500 million of capacity. That would be the high end for most. So when you start talking about needing to put together a $5 billion or a $10 billion program, you start to see the scale of the carriers that are required, the number of carriers that are required to even put that together. We have seen the development specifically in the builder's risk space for data centers of consortia, specifically in London. We're starting to see that come together. I fully expect that we're going to see that move over to the operational side because it's another lever. It's another available bit of capital to help drive these high limits.
So it looks like, while it might not be easy, the capacity is going to be there. But of course, it's not just a question of capacity. The sheer speed of development is also creating new risk issues. As Lindsay points out, developers are moving so quickly that risk management might not necessarily be front of mind.
Oftentimes you're seeing the developers start moving on these projects and doing the architectural drawings and the engineering drawings before they've even engaged a risk manager because they're trying to move at such speed that the risk management piece of it is almost an afterthought because of the size of these and the scale of these. If something goes wrong, it's going to go really wrong.
From the client side, Atul Roy feels that the insurance industry hasn't adapted fast enough to the speed of the investment, often offering standard products designed for yesterday's risks.
The speed at which the investment is growing, the insurance cover is not evolving as fast to provide that level of risk protection. The risk protection is still coming at the same product level which was before.
You might be surprised, but Atul's first contact point with the insurance industry is almost always through warranty and indemnity insurance when his firm is looking to acquire a data center. Atul specifically highlighted the disconnect between the rigorous due diligence performed by insurers when covering mergers and acquisitions and the process around the subsequent placement of operational insurance.
I wish at the time of acquisition, the W&I came with a lot of other insurances and we can have one bundle. That is a really good window where due diligence is already done, knowledge is already there. In fact, no other further product ever does at that level of due diligence as the first entry point.
Of course, W&I stands for warranty and indemnity. But Atul's request is simple. Stop being so siloed and access the data the industry already has at its disposal through other classes. Indeed, this will become a theme throughout our encounter. Atul also pointed out that a lack of bespoke coverage means that data center operators often miss an opportunity to leverage insurance as a competitive advantage and differentiator when bidding for major contracts. After all, if you could prove to underwriters that you are a better risk, you might be able to get enhanced coverage from them, which in turn should allow you to attract more business.
Right now, we don't use insurance as an additional, we just meet the minimum requirement or what is this industry standard, because that's the product out there. But if we have a more bespoke product, that will also go in our bidding, that this is the level of coverage we take.
So we may have trillions of dollars in new investment coming on stream, but the first problem we've identified might not necessarily be capacity, but a lack of product differentiation and joined-up thinking between lines of insurance business. I suppose that if it's all hands to the pump to get the massive limits assembled, perhaps more sophisticated risk differentiation might emerge when $10 billion limits become more standard. But now it's time to move on to the next obvious new source of demand beyond the properties themselves: power supply. The huge thirst for power of the largest centres is forcing developers to seek independent generation solutions, often renewables. This is where renewable energy underwriter Ben Shepherd comes in. Renewables, particularly solar, are quick to deploy and have become economically viable.
Obsolescence is a real big issue and risk issue in our market. So where cutting edge technology is used 5 or 10 years ago, it's not cutting edge by the time a loss might come around.
This means that replacing damaged equipment with an exact match is difficult or impossible, often forcing developers to look for newer, more efficient models. A betterment issue for the insurer, complicated further by planning and permit requirements.
It's also a challenge for our clients because our clients might not be able to source those parts or that equipment if the turbine supplier that originally manufactured something 5, 6, 7 years ago, if they've been acquired, if that model is being discontinued. It's not like the motor market where you can get an exhaust for a 10-year-old car quite easily. It's not always easy because the turbines are getting bigger. The technology is improving, so to find parts or replacement units for a 7, 8, 9-year-old wind turbine can be very, very challenging.
This challenge sometimes results in clients opting for agreed value policies, so they can simply take the cash after a loss and decide how to invest in newer technology rather than grappling with replacement. Ben also detailed how rapid iteration in solar panel technology is being used to mitigate catastrophe risk.
So we're now seeing thicker solar panels, thicker glass on the panels, I should say, better stowing. So there's some tracking technology that allows solar panels to stow at up to 70 degrees. And by stowing better, it presents smaller surface area to the direction of the hail. So this new technology is coming in. The insurance market is embracing it, engaging with it. And yes, we certainly hope to see reduced incidents of loss as lessons have been learned.
This engagement with new engineering solutions is vital, Ben noted, because it drives improved safety standards within the industry.
I think the insurer's job is to provide the best possible product for clients, and insurance and insurers will help drive best practice. So where we see things that we have questions over, it is up to us as underwriters to push back and to demand that clients and brokers are able to make us as comfortable as possible with the risks that we're accepting.
But of course, the biggest risk that the data centre owners and operators and their property underwriters are worried about is an outage causing a failure to supply electricity to the centre. Data centres need 24/7 power certainty and cannot tolerate intermittency of supply. To bridge this gap, battery energy storage systems, or BESSes, that kick in when the sun doesn't shine or wind doesn't blow or there's an unplanned outage, are becoming critical components of the renewables ecosystem.
If we wind the clock back 5, 6, 7 years, batteries, BESS systems were not very common. They are now incredibly common, and they make up a material share of our underwriting portfolio.
However, as anyone who follows the news will know, batteries bring very specific fire hazards. Indeed, large arrays of huge batteries have introduced one of the most severe fire risks the property market has faced: thermal runaway.
Thermal runaway is a major risk that we look at. It is actually a chemical reaction. So when a BESS catches on fire, it's a thermal runaway. And what that means is that it's a self-sustaining reaction. And what that means is that if you were able to get a BESS that was under thermal runaway conditions, and if you could throw it into a swimming pool, for example, it would continue to burn.
Ben notes that costly lessons have driven the industry standard away from indoor BESS systems, which were commonly housed in repurposed power stations, towards outdoor storage, with wide spacing to prevent propagation. The sheer financial impact of one such loss in California was huge.
I think it was somewhere between $500 million and $1 billion.
Just of pure property.
And business interruption. And also because it's in California as well, the site clear-up costs will be a lot higher than they would have been if they were elsewhere.
As Ben just mentioned, the combination of extreme heat, toxicity and sustained burning makes BESS debris removal a significant environmental concern, linking Ben's portfolio directly to environmental specialist Nicholas Pearson's world. That's because, from the environmental perspective, the fire itself presents secondary liabilities due to toxic residues and potential contamination from whatever was used to put the blaze out.
There's a residue, there's potential runoff with whatever extinguishing media, although they tend to be gases. There are toxic vapors that come off when they burn as well, which could cause problems, toxic vapor clouds. When you've got close communities nearby, that could be an issue.
So, batteries and what happens to them and the surrounding environment if they ignite are another important source of exposure to be aware of. But there's something else. Data center efficiency is tied to a critical measure: power usage effectiveness, or PUE. PUE is a measure of how effectively the power brought into the data center is used for computing versus ancillary needs like cooling and lighting. A PUE of 1 is perfect. And currently, the industry is averaging a figure of around 1.2 to 1.5. Our tool highlighted that PUE isn't just an internal metric, it's an uninsured business risk, potentially linked to regulatory fines.
And that is linked with a lot of ESG pressure, including fines, which is coming from the regulatory body. So we have an exposure to that. So in other words, if you're running a very inefficient data center, eventually you will be fined because it's not the right way to run it. And to move it to an efficient data center, you got to make some changes, either move to renewable or change the hardware or even change the type of building structure you have. So there is a risk exposure any data center operator carry on their less efficient data center. And if they have a portfolio of large data center, they want to have 1, 2, or 3 somewhere which will be less efficient. So they are running a risk of getting penalized for doing that, or a capex risk of fixing it. And that is not covered in any shape or form at the moment.
Moreover, PUE correlates directly with revenue stability.
Whenever a revenue type of cover is provided, like a revenue protection, a site which has a lower PUE is commercially a very strong site because they waste less energy, they have better margins, and even end customers prefer them. So the revenue risk is lower with a lower PUE. Revenue risk is higher with a higher PUE.
So, as environmental demands increase from buyers and the pressure from regulators for improved energy efficiency grows, PUE is a big factor that the insurance industry might do well to get its head around. Once again, we're looking at demand for a product that the industry isn't currently offering. The discussion of PUE leads directly to a core concern for property underwriters like Lindsay: business interruption, BI. If power goes down or the system overheats, the BI exposure is massive, compounded by long lead times to replace specialised equipment and the risk of losing customers permanently as a result.
It's the business interruption.
Yeah.
It's the BI that is the biggest concern. And many say that energy is the largest driver of risk for these data centers. And if it takes you that long to get reconnected to the grid, you don't have those contingency plans in place to get yourself back on the grid or to get your independent power supply back up, the business interruption could run away really quickly.
Lindsay expanded on the challenges of calculating BI, noting that delays in startup, DSU, and long replacement times for specialised servers mean that traditional annual BI limits are often insufficient.
When you look at these data centers, you think about some of the equipment replacement timelines. I mean, some of this sophisticated equipment is on a multi-year replacement timeline. So now you're looking at several years from a business interruption loss. You look at the availability of alternative data centers, and depending on how that client's contracts are written with their customers, could those customers choose to go elsewhere, in which case that is lost revenue for them forever? When you look at just the scale, quite frankly, of the construction, and depending on the extent of that fire, for example, how long would it take to rebuild it if you had all the supplies, if you had all the material that you needed? So understanding the client's contingency plans, being able to quantify or at least create a general quantum of how long we would expect that location to be down in a variety of scenarios, in a standard kind of normal loss expectancy scenario, as well as a maximum foreseeable loss scenario. A lot of these clients you're seeing are starting to involve accountants, forensic accountants, to help them calculate these business interruption exposures, but the quantum of it is materially different. And you look even on the builder's risk side, so delay in startup or DSU coverage is traditionally a couple of months. So that if there's a delay during construction, you have some revenue recovery because of that delay. Well, a delay in startup for a data center that took 3 years to build in the first place, again, could be massive. So that's going to put additional pressure on the available limits and the available program terms.
This complexity necessitates highly sophisticated loss modelling, moving far beyond what was required for old factory sites.
It's a combination of on-the-ground engineering, looking at all of the natural disaster perils that location faces, looking at the fire separation, looking at the fire protection, looking at those contingency plans.
This is driving interest in innovative solutions such as parametric insurance, which could provide a rapid capital injection for losses triggered not just by physical damage, but by metrics like energy usage or cooling efficiency.
But I think it'll be interesting to see some of the innovation within the parametric world. Could you build a parametric product around energy usage? Could you build a parametric product around water consumption and cooling efficiency? If something overheats, if there's insufficient water supply in an area, there's a drought in an area that impacts the water supply, could a parametric product respond to that? That would not be something that a traditional property policy would respond to.
So the emerging parametric community may be another group of insurance professionals that this boom in demand will call upon. But whilst power generation and the potential for losses caused by interruptions in power or water supplies grabs headlines, what about the traditional operational fire risk? How's this evolving? The physical operations of these new data centres and their cooling and fire suppression systems are also rapidly changing, introducing new risks. Atul explained that server racks are becoming exponentially more powerful and therefore much more prone to overheating and potentially combustion, making cooling failure a high-risk event.
The racks where you put the servers, they are getting not just 10 times, they're getting 100 times more powerful. That means they will also get that many times hotter. So you need to cool them. So the problem, what I'm getting to is, if you trip on a wire and cooling goes off, it's less dangerous today than what it would be in future. If you trip on a wire and then the cooling goes off, and within minutes you cook up that server, may even catch fire and so on with that kind of high power rack. It looks nice because you could do so much in little space, but it also means it's very, very susceptible to cooling risk, cooling exposure. So there is a new type of fire hazard there, which needs to be very carefully monitored.
So there are new fire hazards as well. Add to this the fact that traditional fire suppression systems, often wet pipe sprinklers, are incompatible with the dry, humidity-sensitive environment of the data halls, where a mere drip of water can cause an outage. Lindsay confirmed that dry pipe sprinkler systems are generally preferred to avoid nuisance water damage claims.
So dry pipe system, when the water is not sitting at the sprinkler head, the water, once the sprinkler head is activated, the water then starts shooting through the pipes to the sprinkler head. It does create delays in getting the water to each of the sprinkler heads, but what it prevents is the attritional nuisance water damage claims from sprinkler leakage. So a traditional wet pipe system in a server room would be a nightmare from any sort of water damage. You can't risk any amount of water getting into those rooms. So dry pipe systems have been most commonly deployed.
So there's a compromise between speed of suppression and the avoidance of attritional losses. Furthermore, large-scale data center development is heavily dependent on water, forcing some sites to locate near major water sources, leading to accumulation risks and potentially local community backlash.
Water consumption is a major driver of where these are located at this point. It's one of the reasons why you're seeing some development starting in the Midwest with the intention to draw on some of the Great Lakes, like Lake Michigan, which is bringing a whole host of environmental concerns, sustainability concerns, and the water consumption risk isn't just at the data center. So I live in Atlanta. Just south of Atlanta, there's a large industrial park that houses a number of data centers. And it's been reported that the local community has seen a significant drop in the well water supply. So now I'm not only worried about sufficient water supply to fight fire at that data center, but what if I've also got exposure to clients elsewhere in that general geography, and a completely unrelated client has a fire, but because of the drain on the water supply, those firefighters don't have sufficient water supply to adequately fight the fire.
Another key consideration is the external physical structures themselves. Data centers typically resemble large warehouses. While internal firewalls may segment the buildings, the massive roof area and, of course, the adjacent wind or solar farm or other power generation facility remain a single indivisible exposure to natural catastrophe, particularly severe convective storms, SCS, and hail. Over to Ben.
I think the main challenges for renewable energy underwriters and owners is primarily around cat risk. So extreme weather scenarios, there are a lot of stories around hail damage to solar projects in the United States. One report estimates that 75% of all claims related to solar relate to severe convective storm and hail. So if a data center is being sited in an area where there is high natural catastrophe exposures and perils, then there is a chance that the insurance capacity will be challenged on that.
As Lindsay noted, the clustering of these huge facilities in hotspots exacerbates this accumulation problem. If a tornado or massive hailstorm rolls through one of these regions and hits multiple locations, the industry could face multi-billion-dollar losses from a single event. However, one mitigating factor that Atul noted was that data center customers are highly risk-averse regarding location, which at least provides some natural protection for insurers.
People put their very critical data in data centers, and they get very, very cautious about location. This level of caution already discourages people from using locations that could be high risk. However, if they are building it for their own consumption and not selling it to the end customer, and they are extremely cost conscious, they may go to such locations. So you have a subsection of the industry who may do that. Vast majority would stay away from anything which already looks high risk to the end customer.
So once again, no two risks are ever the same. Someone building their own data center may be more comfortable with greater property risk than someone else who is selling security to their third-party customers. It's time to return to environmental themes. As we heard earlier with the reference to expensive cleanup costs following battery fires, the environmental risks associated with data centers are also growing. Nicholas Pearson focuses on pollution liability, particularly the dual risks of pre-existing contamination on brownfield sites and operational pollution, principally from power generation. Many developers are acquiring brownfield sites, such as decommissioned coal-fired power stations for their low price and pre-existing grid connections. But of course, redevelopment can uncover legacy pollution issues. Over to Nicholas.
The legacy that you're acquiring when you purchase something like a piece of land that's had a former use, a prior use, and essentially what you're doing is picking up the exposures that those prior uses had. And that could be a couple of years of industrial use. It could be decades of industrial use. And so that's one of the challenges waiting to get you in it. And it could be something that's fine as it is, contained on the land. But then when you develop that site for something like a data center, you could be revealing or exposing or causing to migrate a pollution condition that's there.
Nicholas explained that the rush to market can exacerbate this risk.
I'm going to come back to the brownfield site situation where you might have an investigation that you need to do, and you might pare that down to fewer sampling points, for example, just to get it done quicker, and therefore the uncertainty increases during the development stage.
Also, while BESS are becoming much more prevalent, more traditional power sources, like diesel generators, still represent a tried and tested essential backup system, with most sites still typically holding large reserves of fuel to keep them supplied in emergencies. Atul Roy mentioned that one of his firm's New York data centers holds 96,000 litres of fuel on site. Unsurprisingly, this presents a significant environmental exposure.
You have to have quite a lot of diesel on site to maintain the power supply, if you will, and the loss of containment would be my biggest concern there. You've got things like underground storage tanks which do leak. You can have sudden releases in those, but generally it is gradual. And then you discover it when some drinking water source is being pumped out somewhere and there's diesel in it, and it tracks back to your site.
As if solar, wind, batteries and good old diesel were not giving underwriters enough to contend with, the data center industry is eyeing even more radical power solutions to meet demand, including small modular nuclear reactors, SMRs. For insurers, this presents a foundational challenge due to the traditional nuclear exclusion. Back to Lindsay.
Nuclear has been a dirty word for a long time. It's long been excluded in property policies. I think this is another one of those areas where it's going to force property underwriters and energy underwriters to really sit down and make sure that there is a clear understanding of the risks of nuclear power. And then how do we develop products, whether within a property policy, whether within an energy policy, that can adequately insure those.
Ben Shepherd noted that the market needs clarity from regulators and reinsurers before SMRs can be widely insured. Similarly, fusion reactors, while cleaner and safer, are still future risks dependent on proving technology and cost efficiency. Now on to another core peril, cyber risk. While we traditionally think of cyber in terms of data breaches, data centers present another unique operational risk exposure to this peril. Lindsay emphasised that for these facilities, the cyber risk isn't about hacking customer data, but rather hacking the shutdown risk to the facility itself.
It's not the traditional hacking risk for a cyber loss here. It is the operational tech risk for that loss. Nobody's worried about a data breach. Somebody's worried about somebody coming in and hacking the system and reconfiguring the system and shutting it down.
Atul also noted that operators often lack the necessary expertise to accurately assess their cyber risk, leading to gaps in coverage.
But cybersecurity is always like a parallel thing that somebody might attack me somehow. but they don't know how, so their coverage sometimes can be spread thin. So I think that's probably more of a client's responsibility as well as perhaps the insurance sector to educate. But we have seen often there are gaps in cybersecurity insurance, which we tend to fill after our acquisition.
A tool proposed a solution. Insurers should require certified risk mitigation measures in exchange for providing superior coverage, essentially mandating better risk management practices.
So if an insurer comes and says, I'll provide you a very high level of cybersecurity cover if you make sure you have these certifications, which are standard sort of firewall level certifications. And that will work very well in a balance with both parties.
So how should the insurance industry be responding to all of the above? As you've heard, the consensus across all our speakers is that the data center boom is a multi-line problem, encompassing construction, property, operational BI, renewables, environmental liability, and cyber. Given the scale of these new investments, the potential coverage gaps between these traditional silos could be measured in billions of dollars. Lindsay believes the market must develop cohesive products quickly.
We have to design the right product, and we have to design the right product with speed. Because again, the development of this is moving so quickly, we don't have the luxury of waiting a year or two to test the product and to look at it 8 ways to Sunday. We have to develop the products that work now, and we have to get those out to clients now.
Nicholas agreed that streamlining the offering is beneficial to mitigate these gaps.
Certainly a good broker would be able to assist with that. And certainly, a good carrier, when you've got products coming from the same carrier, they tend to be more aligned and prevent the gaps.
A tool's most pressing request to the insurance industry was precisely this idea of breaking down silos.
I would request that we have a more connected insurance structure, at least from the bigger firms could perhaps do that, where I mentioned the W&I insurance, where they are already so much aware of the business, can somehow be passed on to their divisions who provide other insurances. And then you get already a very informed and a very detailed insurer. The other thing would be the adaptability of how things are evolving, giving more customization and adaptability. As I mentioned, two sites are not the same. The PUE difference makes a difference on revenue insurance. The location have different requirement on ESG or coolant that makes it less riskier than the location which does not have these requirements. So as they see the risk profile changing, they can provide different kind of covers.
So, no silos and the ability to differentiate between clients are the key requests. The data center opportunity is undeniable, potentially generating billions of dollars of new property premium alone, not counting the huge growth expected in environmental, energy and cyber markets. But this opportunity comes with an urgent mandate for the insurance industry to embrace complexity, customization and speed to transforming its traditional operating model to meet the non-linear risks of the digital age. Let's summarize. The construction risk is huge. The resulting property asset is enormous and also bringing new cat exposures. The servers inside the new property are changing and are getting more powerful and hotter, presenting a greater fire hazard. Full business interruption exposure is not fully understood and almost certainly underinsured. The new cyber risk is considerable. New energy risks are substantial and are interconnected. Environmental exposure from use of water and release of contaminants following fires, leakage of fuel, or simply from the redevelopment of brownfield sites is also large. And that's not even considering the potential deployment of novel nuclear power. There are also brand new exposures around energy efficiency and ESG from our new and potentially very expensive three-letter abbreviation, PUE. But what else have we failed to discuss? The above are all risks emanating from a tech boom. But it's also true that the insurance industry itself has been getting much smarter, deploying this new tech to become better underwriters. Tech might be the problem, but could it become more of the solution? Let's go deeper into some of the specific technical challenges the underwriters face, particularly regarding risk management and the use of data. As we've heard, a tool strongly advocated for a customizable insurance product structure, arguing that generic coverage almost always fails to reflect the nuanced risk profiles between seemingly similar facilities. He proposed that if insurers could leverage deeper data analysis, they could offer superior pricing based on client-specific risk controls, such as PUE scores or specific location characteristics.
I've found insurance industry historically have always been very good at data analysis. That gives them the blueprint. And with the AI coming in, I think if it's used in the right way early on, that would give an even bigger advantage to one insurer over another insurer, because not only you can gather more data, you can now analyze it much better.
Nicholas confirmed the utility of AI in his field, particularly for sorting through the vast amounts of environmental data required for site assessments.
I think it's useful for when you've got a vast array of data that you need to assess or at least get some sort of trend analysis. It can certainly condense large quantities of data, and that is useful.
Ben also noted that whilst AI is currently limited to mechanical and clerical tasks, its role is expanding, particularly in running claims data and building cat models for weather patterns.
In terms of running claims data through AI, I can see that's happening more and more. And also in terms of building cat models where we know that AI is being used to help with Monte Carlo simulations on weather patterns for things like severe convective storms.
However, the underwriting process, particularly for complex and novel risks, still demands human subject matter expertise, not just algorithmic decision-making.
It is playing a role alongside subject matter expertise. We can mechanize and we can add some automation, but we do need that sort of kernel of subject matter expertise as well.
Finally, regulation plays a key role, particularly in environmental liability and ESG pressures. Nicholas noted that changes in regulatory standards can fundamentally alter the liability exposure of a site, even years after development.
Something does change. It doesn't change that quickly, but that's the benefit of buying a longer-term policy, such as 10-year policies for existing conditions, and where you have perhaps an example would be where you've got a pollution condition that can remain on site because it's below a certain level, but then down the line, regulations change, the standards change, and that amount drops, then the benefit of buying a longer-term policy is that you can have these reopeners and regulatory changes managed through the policy.
It's time to conclude. The data center industry's rapid expansion, driven by the explosion of AI-driven data processing, is creating an environment where traditional perils interact with novel technology to create exponentially greater exposures and some of the best opportunities for entrepreneurial insurers we've seen for a generation. The key takeaway from our experts is that insurance must move past standard coverage and embrace customizability, data sophistication, and cross-departmental alignment to capture this immense market opportunity and adequately protect the digital infrastructure of the future. It's clear that no two data center risks are going to be the same. Even though they might both be looking to buy a $10 billion property limit, that's where any similarities are immediately going to end. Both risks require huge capacity, but it's clear that ultimately the brokers, insurers and reinsurers that can combine nuanced sophistication around location, operations, power generation and supply, business interruption, environmental, cyber and myriad other possible perils are going to be able to serve the best clients and differentiate themselves and ultimately the results they produce in their underwriting books. The prize is huge, but there's an awful lot of work to do. You'll definitely be hearing much more on this nascent class of business as the coming years unfold. I do hope that this podcast has given you plenty of new ideas. Thank you so much to Atul Roy, Lindsay Shipper, Ben Shepherd and Nicholas Pearson for sharing their expertise, and to Beazley for their support. Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.